Welcome back to another episode. Not too long ago, a few months ago, I wrote a column on anchoring, the concept of anchoring. And I was really shocked because typically when I write on something or I have an idea of writing on something, I go back and search my archives, which, heck, I think they go back to 2007 now, and see what I've written in the past. And on this particular topic, there were several columns I mentioned the concept in, but I couldn't find one column where I ever focused entirely on anchoring. And I thought, well, I'll get some information on the topic from the co-authored book I wrote with Deb Kaplan on coupleship called Coupleship Inc. Because we wrote on cognitive biases, and it's kind of a joke that when she brought it up, I said, we're not going to have cognitive biases in this book. And my resistance was that behavioral finance, which I've talked about, which is not financial therapy at all, and it's sometimes conflated, where cognitive biases are about the shortcuts that we take, how our brain operates, and usually is applied to the masses. And financial therapy is about the person. And I had never seen anything done on relating the cognitive bias to what's going on emotionally within an individual. So that was kind of fun. We did that, and we did it on 8 biases. And as I'm looking at them now, one of them was not anchoring. So that was of no help. And I was reflecting on that. And I was thinking, well, the reason that I didn't move to include it is I couldn't see what anchoring had to do with couples. And just in the last 10 minutes, kind of in thinking through and preparing for this, I've just completed another couples training, IFIO, and intimacy from the inside out. So my mind is kind of focused on couples right now. I could see how it would apply to a couple. So first, before I get into that, let's just clarify what anchoring is. And the word is taken from an anchor. And this is a cognitive bias that happens when we take at face value or we rely too heavily on a piece of information, and oftentimes it's the first piece of information that we receive when we're going to make a subsequent decision or a judgment. So this information that we take in, that we are relying on heavily, is the anchor. That's going to be what we compare everything else to. So it can really have an influence on decisions, especially if that anchor, if that bit of information is arbitrary or irrelevant or erroneous. So some examples of where we anchor. Let's go emotionally to a couple. And if some of you have some other examples or think that this example is off, this is brand new material. You're the first to hear of it. I haven't even written about this. But in a coupleship, it could be that first impression, that first experience, maybe the experience of, and that, I forget what they call that initial phase, limerick? I'm not, it starts with an L, where there's just a lot of infatuation and connection and excitement, and this is just so new. And we can anchor on that in that the story that we make up is this is how it's always going to be. And we can anchor on so many things. We can anchor on personality. We can anchor on habits. We can anchor on health. We can anchor on cognitive ability. I mean, just so many things that everything going forward is compared to that. Now, it doesn't necessarily mean that anchoring is bad. Maybe we can anchor on a particular skill a partner has, and they improve. Well, that's cool. Usually the problems happen when we anchor on something and there's a decline from that anchor, that things are not as they were. With like being an Enneagram type 1, we have parts of us that are not usually, what I want to say, flexible, receptive to change. We have parts of us that hugely anchor on this is how it is. And so we can be not willing to adjust judgments, adjust decisions based on that anchor unless we can have perhaps more objectivity or more flexibility around the anchor. So, and we can do that in all sorts of situations. And typically an emotion that comes up with anchoring when things change in a less than way, and that's maybe a little judgmental in itself, but when things change, is fear can be a huge emotion that comes up. Sadness can be evoked in the sadness of the change. Of course, above those can be some anger, that will be present. Hurt could be present. So there's a number of different emotions that can come up around the anchoring. And that takes some self-exploration on our part to look at the part of us that is anchoring, that is fixated on that data or that experience, and really becoming inquisitive and curious as to what the hope was on anchoring on that data, and what is the fear if that data isn't true, if that anchor was somewhat of a erroneous or fleeting bit of information. And of course, this is very much a part of finances, of our money. we can anchor in so many things. We could anchor on the salary that we're receiving. We could anchor on the price of something. Going out to eat and prices go up. And we can experience the emotions of anchoring of, well, but I was just here last week and it was very different. I think the most common form of anchoring that I have dealt with as a financial advisor is in the area of investments and the prices of various securities or investments that we own. Imagine this. This is somewhat how it works. You've decided to invest in a portfolio that's ideally diversified amongst a number of asset classes, some stocks, some bonds, some real estate, maybe commodities, maybe some alternatives. And you watch that, and maybe for the first year you watch that climb and climb and climb and climb and climb. And various investments that you have in that portfolio, maybe they're hitting new market highs. Maybe it's the stock portion of the portfolio. Maybe it's the real estate portion. It could be anything. But they're hitting new highs, and you're seeing the money that you invested. Maybe it's $10,000, maybe it's $100,000, $1 million, whatever it is. That $100,000 now a year later has grown to $120,000. And you might be feeling like a financial genius. Like, what is it to be concerned about? This is great. So you have a lot of excitement and joy and anticipation. You're just feeling that life is pretty good. So a lot of light feelings. Maybe even start envisioning that if this continues this way, I'll be able to retire early. Maybe I'll get to take some vacations or do some things I've always wanted to do. Whatever that is, it's very pleasurable. But then reality kicks in, and that's the reality in markets, because the reason that we invest in stocks, bonds, real estate, commodities, things like this, and not a savings account or not CDs in the bank, is typically to get a better return than those investments. And it's true, money we put at risk in various markets in ownership over a long term typically does better, and oftentimes much better, than money that we loan or that is not at risk, that's at a bank. So the reality, which we may not even be aware of or anticipating, sits in, and markets take a nosedive. Real estate goes down, equities go down, maybe the absolute return goes down. Recently, bonds were in the worst bear market in 150 years. And when this happens, the overall return on our portfolio goes down. So let's take that situation where we had 120,000 and we look at it and it's now at 105, let's say. I can't tell you how many calls that I've received from clients in the past, really concerned. sometimes really upset that they have lost money. And a panic can set in, a real fear. All sorts of thoughts can arise from this, just depending on our experience and depending on our past financial traumas, that we're losing money. What does that mean? It means I have failed. It means I'm going to be homeless if this continues. Just a lot of messages, many messages can creep in. And parts of us just think we're hemorrhaging cash. Look, I've lost $15,000. And sometimes that can happen very quickly, like within a month. And anxious parts that are wanting relief. And oftentimes that relief is, let's sell out. Let's sell out while we have something less. And maybe the market continues to fall, and now it's down to 95,000. That's less than what I even put in. I could have done better in CDs. And that's true. Could have done better with money in the bank from the time you put it in and the very time you're looking at it at 95,000. So all the feelings of lightness and happiness and the dreams of the future have really gone out the window because we have, quote, lost money. So that is a pretty good example of anchoring, especially, let's go back to when the portfolio was down from 120 to 105,000. When you look at the long term, the portfolio is up 5%. That 100,000 has grown to 105. Historically, let's say over 10 plus years, that's what you typically expect from a diversified portfolio. 5% is a pretty good return, especially if historically inflation averages around 3%, and what you can get on CDs can average 2.5%, maybe 3%. You've done considerably better. But that's not what we focus on. That's not what our brain fixates on. It fixates on that 120, and had I sold then, I'd been so much better. When in retrospect and in the big picture, the 120 wasn't sustainable. That's a 20% return. And we're talking in a year here. We're talking in a year. And this is very short term. When a portfolio is up 20% in a year, the information that we need to take in to those parts of us that are so afraid and so anchored is that is overperformance. That's too good. It's not going to continue. Now, it may for a while, it may for 2 years, 3 years, 4 years. It's highly unlikely that a diversified portfolio would return 20% over 10 years. Likewise, when that portfolio is at a loss, we put in 100, it's at 95, 90, 75. We can also work with that part of us that's just scared to death. And again, this is assuming we have a diversified portfolio, which is in the long run pretty conservative and safe, that things will get better, that this is not sustainable. So again, this is just kind of a quirk of humanity where we fixate on a specific reference point and use it as the holy grail of comparison, in this case of investment success. So that's something to really be aware of, and to be aware of. So when that happens, that we can bring some objectivity to ourselves and hold ourselves from making impulsive decisions like selling off all of our investments. Or maybe it's just the stock investment, or whatever investment is losing. Maybe it's bonds. To try and regain a sense of control and calm, and to subdue, push aside, repress that anxiety. It's kind of like you're on a cruise, and it's something that I know a little bit about. We've done a lot of cruising, and it's smooth sailing, and then some waves kick up, and then you start seeing some white caps. Maybe the ship starts rocking a little bit, and when we anchor, in that case, we're like, OMG, let's head for the lifeboats. This thing's going down. And that's what we want to try and avoid in a compassionate way with ourselves, and not to shame ourselves for doing it, not to try and white knuckle through the experience, but it's to really understand that part of us that is so afraid and so anxious, and do some inquiry on that part of us to try and understand, where is the fear coming from? What is underlying that fear? And oftentimes these fears will go back to when we were much younger, sometimes in childhood. I could just bring up a lot of potential examples of where this could start very early in life. And once we can connect those dots, I can't tell you how many people have, when we've just started peeling the onion on, well, what's that fear? It's a fear of I will be homeless, that I'm not going to have a penny. Maybe that goes back to an event, a time in childhood, witnessing parents going bankrupt, witnessing losing money. Just so many things that when we can be with that younger part of us that probably is still traumatized, that nobody was really there to explain and understand and affirm and validate the emotions that we were having. Those really deep wounds get triggered again with something as, quote, simple as volatility in a portfolio. So that's the part of what can help us begin to take market dips in stride, and to recognize them as just speed bumps along the way, rather than barriers that will destroy us or that we can't get through. Learning that those blips are not going to derail the investment journey, or the financial journey, or the financial decisions that we're looking at. And from an investment standpoint, gaining the knowledge that this is normal. This is absolutely normal. And to look at a portfolio when it hits an all-time high as, well, that's cool. It's highly doubtful it's going to stay at that all-time high. It might go higher and it might go lower, but that's part of it. And I get it. When I've looked at my retirement portfolio and seen it doing so well, and then it's down 5-10%, I have those parts of me that get anxious and get concerned. So it's really important that we work with ourselves and attempt to, sometimes some knowledge can be helpful, but it's usually only after we have validated and affirmed the feelings that we're having, and not shaming ourselves for being anxious and upset or panicked because the market's going down. Self-compassion is so important in growth, in personal growth, and in our financial growth. So if you have a problem doing that internally by yourself, there's lots of resources available. Having a talk with a in-tune financial advisor, a financial life planner, or of course a financial therapist can really help, because they can help acknowledge those parts and help bring some perspective to their fears, validate those fears, and these can be money scripts that are true in the situation and not true in the circumstance. And oftentimes when we have money scripts that are not true in the circumstance, at one point in time they were true, but they didn't evolve as we grew up into adulthood, and they're still there and anchoring us internally to those beliefs. So kind of wrapping up today, it's just important to know that this type of anxiety from anchoring is very normal. It's very common. It's good to work to a place where it's viewed as short-term, maybe not. Try to bring some lightness, some humor to the system. Like I had one client once said, "Oh yeah, that's my money script talking again. I get it. I understand why." So in the big picture, make sure you have a diversified portfolio when you're investing. That underscores everything that I was talking about. And have support. Talk with your financial therapist and advisors, and just try and maintain stability when it comes to financial decisions. So I am wishing you smooth sailing through the financial seas without dragging your anchor along. Take care.